disappointed the street more? That 13,000 crore sweet offer in FY18 didn't seem to assuage any sort of concerns in terms of the soft quarter that they delivered. Reema, what are you picking up? You've been working the phones as well.
Well, you know, the 13,000 crore was largely factored in by the market. The street was expecting a $2 billion extra cash repayment by the company. So yes, it comes in on expected lines, but it was unlikely to do wonders for the stock. What is disappointed? One, that Q4 is softer than what the market was expecting. Their FY18 guidance is not the lowest estimate on the street, but it's not a great growth year for the company. At 6.5% to 8.5%, at the upper end of 8.5%, the company will at best deliver to what FY17 was, which was 8.3% in constant currency, which basically means in all likelihood in FY18 you're going to see some deceleration in growth yet again. What is preventing a big fall in the stock is the fact that the stock has already fallen. Towards the end of March, the stock was at levels of close to about 1,040. And from there, it already came down to levels of about 950. So at about 80 to 90 rupees, the correction had already taken place in anticipation of the market buzz of a weak quarter and a soft guidance. So that's the reason why, we haven't seen a big fall and the stock is taking support around the 950 mark. Onto some details about how the quarter has panned out. Dollar revenue growth of 0.7%, softer than market expectations of 1 to 1.5%. Margins have come down by 50 basis points to 24.6%, and that is driving a bit of a decline in the profitability. Their FY18 guidance stands at 6.5 to 8.5% in constant currency, and this would compare with 8.3% that they delivered in the prior year. But if you see how the growth has been coming down, in FY16 their growth was at 13% plus, and now it's going to be in the mid-single digits. With respect to margins, it doesn't come as a big surprise because we've already seen a 3% rupee appreciation. So margin range has also come down, 23 to 25%. The earlier margin range was 24 to 26%. And in a span of 2 years, margins have come down from close to about 26%. With respect to, the capital allocation, earlier the dividend payout was 50% of post-tax profits. Now they're making it 70% of free cash flow. This effectively means some increase in their dividend payout. So if you do a like-to-like comparison, in the prior year, the company would have paid out 63% of their free cash flow, and now they will be increasing it to 70%. So there is some increase, and that was not expected by the street. The $2 billion or 13,000 crore of additional payout by way of dividends and buyback was expected. But that some increase in dividend payout was not expected. And, this is going to be ongoing. It's not just for 1 year. They're saying effective FY18 onwards. So that is, a positive. Other than that, if you look at, the individual geographies, North America did reasonably well. Europe and India was a bit subdued. With respect to industries, finance or BFSI had a 0.5% growth in constant currency. We saw softness in retail there. The management also said that, we've seen the highest number of store closures. There's been a lot of disruption in retail. So that I think could be a soft spot going forward as well.